Okay, folks. So I've got to do my obligatory nagging. So let me start with the nag. Tomorrow you will get a to-do list for the project, so basically listing out everything that needs to get done. And most of you are pretty much through that to-do list, I would hope. But I will send that to-do list tomorrow just as another way to nag you. So basically, watch out for that. And I'll list out everything left on the project all the way through that last day when it's due, which is May 13th, the last day of class. The other is your final exam. There is going to be an early version of the final exam on May 14th because some of you have issues with the with the later date because you're traveling or you start a job, an internship, whatever. So that will be on May 14th, and I'll send out the time and a room, and I'll set up a Google sign-up sheet because there is only limited space in that room. So if everybody tries to get in, then I've got to figure out what to do. I don't think I can move the whole exam that early. But the downside is it'll be the day after the final day of class. You really don't have much time to prepare, but you really need to get the exam done early. It'll be May 14th, time and room to be announced. Okay? So let's start today with building on something we talked about last session. Remember we talked about undeveloped oil reserves as an option? Okay? And the optionality comes from the fact that oil prices can change. So even if you have reserves that are not viable, I said you could still have value for those reserves because you're buying an option. I want you to remember that because today's start of the class test, I'm going to build on that theme. So here's what I'm going to do. Right after I plug in my... So I'm going to show you two companies, and for the case of argument, assume that the numbers are okay. I value two companies. One is Royal Dutch and the other is Petrobras. Let's assume they have the same value. But here's where they're different. Let's assume Royal Dutch gets a bulk of its value from developed reserves, and Petrobras gets a bulk of its value from undeveloped reserves. The value today is the same, and let's say today's oil price is $60 a barrel. So today you valued both companies correctly. The price per barrel of oil is $60. Tomorrow, let's say you wake up to a Middle East crisis, which is almost always around the corner. So let's say you wake up to a crisis. And oil prices jump from $60 to $100 a barrel. So let me ask you a question. What will happen to these two companies? First, is this good news or bad news if you're an investor in these companies? It's good news. The price will go up. Will it go up about the same for both? The value is the same for both companies before. Will it go up roughly the same? Which company do you think is going to go up more? And why?
Because value of developed resource for the same quantity is higher than for undeveloped resource.
One is the increased price will make all oil more valuable, but because you have an option, you get a time premium, and now that you've had a jump in the price, that time premium might be greater. But they both go up. But let's make this more interesting. Let's say the day after the Middle East crisis goes away. Don't ask me how that happens. And the price goes back down to $60 a barrel. We're back to status quo, right? 2 days ago the price was 60, now we're back to 60. Will the two companies revert back to the values they had before the crisis? Or has anything changed? Louisa, you want to try? Which will be worth more?
Royal Dutch.
Royal Dutch you think will be worth more? You think Petrobras will be worth more? And you want to do a show of hands? I mean, 50-50 shot, right? Or will they both? How many think will be worth the same? After all, the price is back to 60. It was what it was 2 days ago. How many think nothing has changed and you should be at the same value? Nobody, okay. How many think Royal Dutch should be worth more? Okay. The rest I will assume. I won't even ask you to embarrass myself putting a show. He says, I have no idea. It's true the price of oil hasn't changed, right? But what did the 2 days do? Remember, when we talk about the volatility in oil prices, it's always forward-looking. It's not a historical volatility that you price things on. What did the 2 days teach you? That oil prices can be very volatile. You wake up 2 days later, you're now going to say, you know what, those Petrobras reserves are out of the money, but in a day they can go to being in the money because that's what we saw yesterday. What I'm trying to say is when you value oil companies, It's not just the level of the oil price that drives the value, it's the volatility. What can kill an oil company is what happened in the 1980s. You know what happened in the 1980s? Oil prices went low and they stayed low. They were boring. Boring low is the worst possible scenario for an oil company. Exciting low you can live with. Exciting high is dream time. But boring low kills both the undeveloped and the developed reserves because the value of the optionality goes away. I'm going to do one final piece to this, and this has very little to do with these reserves, but I want to talk a little bit about how you can use option pricing to deal with some interesting twists that can be thrown at you. Let's assume that Petrobras auctions off these undeveloped reserves, right? So you're the potential buyer. Let's say you are ExxonMobil. But they had a condition. They had a condition that you can get the value of all the oil under the ground up to $150 oil price, and above the 150, 100% of whatever you make goes back to the government. Because the Brazilian government says, this is our oil, we don't want to just give it away. So what have I introduced? I've introduced the optionality, but I put a cap on how much money you can make. Because if the oil price goes above 150, your profits are capped. Is there a way I can use option pricing to bring in the effect of this cap? See what I have? I have an option, but now I put a cap on how much money you can make. So if I draw the payoff diagram, it'll look a little bit like this, right? Basically, it'll look like a call, and for a while it looks just like any other call, but then when you get to 150, it flattens out again. So what would I need to do? I'd first value a call with a strike price of 60. That would be my traditional option. Then I'd value a call with a strike price of 150. Why 150? That's where the cap is. My option value will then be the difference between those two. This is actually a general technique that's useful whenever you have caps and floors. So let's say you have a management compensation contract where you're entitled to 10% of the profits on this company up to $5 million, and after that it's leveled up. You got a capped compensation contract. The easiest way to value it is to think of that cap as a second option, with that cap number being the strike price. So file that away, because no matter how I design this option, you should be able to use option pricing to address what the value of the option is. Okay, so let's return back to where we were in our notes on Monday, okay, and talk about another option. This is a very uncommon one, so I want to it's a complex one, so I want you to hang in there with me. So when we do corporate finance, we talk about optimal debt ratios. And the optimal debt ratio for a company is the one that minimizes the cost of capital. So I'm going to take you back. This was 1997, first edition of my applied corporate finance book. I came up with an optimal debt ratio for Disney of 40%. It was actually at an 18% debt ratio. So its cost of capital at an 18% debt ratio is 12.22%. At a 40% debt ratio, it's 11.64%. So if I'm trying to sell Disney on getting to a 40% debt ratio, what am I going to tell them? If you go to the 40%, your cost of capital is going to be about 58 basis points lower than it is today. Sounds like a pretty, alluring prospect. But let's say Disney pushes back and says, you know what, we know we have excess debt capacity, but we're not going to borrow the money. Why not? Because we want to preserve financial flexibility. You're saying to do what? Well, maybe a big acquisition will come along, a huge project will come along. Maybe we'll need that excess debt capacity more in the future, or can get more value out of it. We're not going to use it. So what are they giving up? They're giving up that 58 basis point drop in the cost of capital in return for financial flexibility. So for this argument to have any heft, what has to be true about the value of financial flexibility? It's got to be worth more than 58 basis. If I can somehow value financial flexibility and show you what that number is, then we can take Disney's arguments and does that make sense? So I'm going to try to value how much financial flexibility is worth to Disney, and I'm going to be stretching option pricing models to the point of breaking, but I'm going to keep going. So I want to get a 1-year value for financial flexibility. Here's how I got the inputs I needed to value financial flexibility as an option. Let's start with the S. The S is what Disney wants to reinvest back in the company. So think of that as reinvestment needs. And to compute what those reinvestment needs are, I looked at reinvestment as a percentage of the total value of the firm each year for the last 5 years. So basically reinvestments includes capex and working capital. So basically it's a net capex plus change in working capital. If you do acquisitions, I added that on. I divide that number by the value of the company each year, and the average across the 5 years was about 5.3%. So over the last 5 years, reinvestment as a percentage of value has been about 5.3% each year. But that number has jumped around. In fact, the standard deviation in that number, the variance in that number, is 0.375. You're saying, why is it so high? Because in one of those years, Disney bought Cap Cities for $18.5 billion. The reinvestment jumped a lot. You're saying, shouldn't we take that out? Well, it's not an outlier. It was part of their growth strategy. I left it in. The variance that I got was 0.375. So here's what I know. Disney reinvests about 5.3% a year, but there's a lot of uncertainty about that number. In a typical year, Disney seems to raise about 4.8% of its value from either internal capital, which is retained earnings, or from its regular access to debt. It raises a certain amount of debt. So think of the 4.8% as what they would be able to cover if they had no excess debt capacity every year. And I'm going to value this option over 1 year because I want to get something comparable to that 58 basis points I got, which is an annual cost. So when I plug the numbers in, what I get for the value of the option from an option pricing model is about 1.6092%. You're saying, what does that even tell me? That is the value of the option to take a project. But unfortunately, a project can add value, do nothing for value, or destroy value. So I have to tell you what a typical project for Disney looks like. And to make that judgment of what a typical project for Disney looks like, I cheated. Here's what I looked at. I looked at their existing return on capital and their existing cost of capital. Their existing return on capital is 18.69%. Their cost of capital is 12.22%. They're making 6.47% over their cost of capital. I assume that this next great project they're waiting for will have roughly the same excess returns. That's a leap of faith. But if I put that in, the value that I get for flexibility as an option on an annual basis is 85 basis points. So let's look at the trade-off. They're holding back on using the debt capacity. It's costing them 58 basis points a year, but in return they're getting financial flexibility. And to the degree that you trust my numbers, and you shouldn't trust them further than you can throw them, they're getting 85 basis points back. So what does that tell me? When Disney says, I want to not borrow the money because I value financial flexibility, I'm going to say, you're right. In your company, financial flexibility is worth more than going to your optimal debt ratio. And I'm going to let them stay under-levered. I know these the numbers you get here are extremely noisy because I'm looking at annual reinvestment numbers for over 5 years. But the insights you get when you think about financial flexibility as an option are what I want you to take away from this process. So I want you to think about what drives the value of this option. It's driven by the uncertainty about your future reinvestment, how good your investment is, and what your internal capacity to raise capital is, right? So let me list out some propositions that follow out of this process, and you can tell me whether you agree with these propositions or not. So let's talk about the value of financial flexibility. First, the value of financial flexibility should be a function of how much access you have to capital. In fact, if you're a company with easy and complete access to capital, you can raise as much capital as you want and you don't constrain yourself, what's the value of financial flexibility going to be for you? What's the K in the model then going to be? You can raise as much as you want. The K is going to go towards infinity. The value of this option is going to go towards zero. A large company that can access capital at the drop of a hat, you don't need financial flexibility. You cannot use this argument. So I would expect large companies with access to capital to value financial flexibility more than smaller companies that might not have that access. I would expect private companies which have difficulty raising capital to value financial flexibility a lot more than publicly traded companies. I would expect emerging market companies which have a lot more trouble going to markets to value financial flexibility more than a developed market company. In fact, if you're a company in an emerging market that is subject to market shutting down, take an Argentine company, you might value financial flexibility so much that you not only don't use any of your debt capacity, you might hit zero and keep going. You know what I'm talking about? Basically, you don't borrow any money because you value financial flexibility. And what does it mean keeping going? How do you go below zero? you start to hold cash. Your net debt ratio can actually be a negative number. Why? Because you're so concerned about maintaining financial flexibility that you not only refuse to borrow money, you accumulate cash because you know there are hard times coming. So when you push back and say, I don't want to borrow money, I value financial flexibility, and you're Google, I'm going to push back and say, hey, stop using that excuse. You have $100 billion in cash. You got as much access to capital market. So the argument is going to be weaker when it's made by a large company with access to capital markets than by a smaller company. Let's take the second factor. The more unpredictable your reinvestment needs are, the greater the value you'd attach to financial flexibility. So let's think about what drives the unpredictability of reinvestment needs. If you're an infrastructure company, you pretty much know what you're going to be investing for the next 10 years. It's big, it's negative, but you know what it's going to be. If you're a regulated monopoly, you tend to know what you're going to reinvest for the next 15 or 20 years because you know how many plants have to be built. But if you're a technology company where the business keeps shifting, you don't know what you'll have to invest in, you can very quickly see why the variance in reinvestment is going to be much greater. Companies in unstable, unpredictable businesses should value financial flexibility more. So for those of you working with tech companies, most tech companies will be underlevered. I'll tell you up front, Apple's underlevered, Microsoft is underlevered, Adobe is underlevered, and your first reaction is, how come they don't borrow money? Before you jump down their throats, maybe the answer lies in the fact that they're in businesses where essentially tomorrow you could wake up and you might have to invest $50 billion to keep going. Here's the other factor to think about. What made Disney's variance in reinvestment so high in the 5 years that I looked at them? That 1 year where they went out and did a big acquisition, right? So here's my more general statement. If you're a company that grows through acquisitions, you should value financial flexibility more than a company that grows with internal projects. Because the nature of growing through acquisitions is it's feast or famine. You might have a big acquisition and nothing, and whereas with internal investments, you tend to take 6 projects every year. You, by definition, have more stable reinvestment needs. So I would expect large companies to value financial flexibility more than smaller companies. Companies with unpredictable reinvestment needs to value flexibility more than companies with predictable reinvestment needs. And here's the biggest factor of all. What is it that drives the value of financial? After I valued the option to take a project, what did I multiply it by? The excess returns you can make on that project, right? In fact, if you go back to the previous page, and I made these excess returns 0. Let's assume Disney is the kind of company that earns roughly its cost of capital. If I make those excess returns 0, what happens to the value of financial flexibility? It goes to 0. If you're a company in a business where you basically make your cost of capital, stop talking about financial flexibility. What do you need the flexibility for? Take another 0 net present value project? If you're in mature or bad businesses, there is no reasoning for financial flexibility. What are you going to do with it? So again, when you think about financial flexibility, you're going to see it vary across companies, vary across markets, and vary across time. You will value financial flexibility a great deal more in crisis periods than in boom periods. So all of those factors will kick into how much financial flexibility is worth. Any questions on the value of financial flexibility? So for those of you in corporate finance, here's another factor to throw in. After you found your company to be underlevered, don't jump to, hey, you should borrow money and go to the optimal. You might want to stop and ask, is this the kind of company where I want to keep a buffer? Because that's what financial flexibility is, a buffer that I can use in case I might need it in the future. So let's bring this to fruition by looking at one final example of a real option. Normally, when you buy equity in a publicly traded company, why do you buy equity? Because you want a share of a going concern, right? And what do you hope to get in return by holding that share? If you're old-fashioned, you expect to get dividends on that share. If you are more newfangled, you might say, I'll settle for the cash flows. But normally, we buy equity in going concerns for the cash flows. And that's why when you do DCF, what do? We project out the expected cash flows. We adjust for risk and time value, and we bring them back, and we come up with the value today. But there are times when equity can be bought for different reasons. And to kind of lay out the foundations for what I'm going to do next, I'm going to lay out 2 propositions about equity, and you tell me whether they make sense. Equity is a residual claim, right? You basically get whatever's left over, either of cash flows every year or when you liquidate the firm. Second, equity has limited liability. What does that mean? What's the worst that can, you buy a stock, what's the worst that can happen? You lose everything. You think that's bad enough? But your stock can't go below zero, and thank God for that. There are some stocks where if they let, a broker would call you, continue to call you after the stock is at zero, can you send me $2 more, $7 more? Your stock is now worth minus 15. That's what limited liability does. It stops you at zero. You're saying that happens all the time. If you're a private company owner and you borrow money, that might not be true. Your business could be worth nothing, but what could the banker come after if your loan is structured? They can come after your house, your investments. So when you have private businesses, you don't have, but if you have limited liability and you have a residual claim, you have the foundations for thinking about equity as an option. And let me lay out the parameters of this option. You are the equity investor, you run the firm. As the person running the firm, can you choose to liquidate if you want to? Yeah, you're the equity investor. If you say, look, I'm wrapping up things, I'm liquidating, you will do it only if it's in your best interest to do it. So file that away. You have the right to liquidate the firm. If you liquidate the firm, what do you have to do? You got to pay off the debt. And if there is any money left over, you get to keep the difference. Do you see what my option payoff diagram is going to look like? If you are the equity investor and you liquidate the firm, think of what you get as liquidation as the value of the firm. You pay off the face value of the debt, and what you're left with is yours if your value is greater than the face value. If the value is less than the face value, what's the most you're going to lose? Whatever you paid for the equity, but that's it. That's a limited liability coming to play. Does the payoff diagram look like a call option? It definitely looks like a call option. Equity in a publicly traded company has this option to liquidate, and that option to liquidate is a call option. So let me give you a very simple hypothetical example. And with this hypothetical example, I'm going to extract as much, again, with all of these real options examples, don't get caught up in the actual example that I do because I'm stretching the definition of option price. It's the implications you get for the rest of investing that matter. So here's my very simple example. I want you to play roles. You guys are going to be lenders. You guys are going to be equity investors in a company. Okay? I do the valuation of the company, and I tell you the company is worth $100 million. So that's what the assets are worth. So if you liquidated the company today, you'd get $100 million. Remember, you guys are the bondholders. You've lent me money on one 10-year zero coupon bond. You're going to see very quickly why I made this a zero coupon bond as I go through the description of the option. One 10-year zero coupon bond with a face value of $80 million. So if I decide to liquidate the company, I've got to pay you face value at any point in time. So you're running the company. The company today is worth $100 million. So let's do an experiment. If you liquidated the firm today, what will happen? You'll get $100 million. You'll pay off 80. You'll get to keep 20. Okay? You have, if you think about this as an option, you as equity investors can run the firm, the $100 million. The $100 million can change over time. Why? Because there's risk in the company. And I'm going to capture how much variance or risk there is by looking at the standard deviation in value. Let's assume I can come up with that number. And let's say it's 40%. So the $100 million could go up, it could go down. The $80 million stays fixed, the zero. Okay? The bonds are still out there, you still owe the $80 million. I'm going to give you a 10-year T-bond rate of 10%. And I'm going to argue with that minimalist information. You should be able to tell me how much the equity is worth and what interest rate you guys would charge on the debt. I haven't given you a rating, no cash flows, no cost of capital. And here's how I'm going to do it. I'm going to take the value of the underlying firm, the $100 million, as my S in the model. So that's the number that's changing. The strike price is given. That's the face value of the debt. No matter when I liquidate the firm, I've got to pay the $80 million. I have 10 years to play the game, I being the equity investor. Now do you see why I made it a zero coupon bond? With a regular coupon bond, every 6 months, you as lenders can put equity investors in the line and say, do you have the cash? Here for the next 9 years and 364 days, there's not a thing you can do. They're going to run the company. So you can decide to do whatever you can for the next 9 years and 364 days. At the end of the 10th year, the cash flows come to you. So the option has a life of 10 years. The variance in the value, which is 0.4 squared, is 0.16. and the riskless rate is 10%. S, K, R, T, and sigma. I've got all the inputs I need for an option pricing model. And if this company has a cash outflow happening every year that can affect the value, you can throw that in as a dividend yield. But let's assume that there are no dividends, no cash leaving the company. Let's value equity as an option. So I plug in this S, K, T, sigma into a Black-Scholes option pricing model. And everybody in their lives has to do this at least once by hand. This is almost a rite of passage. If you've done an MBA, have you ever? So that's one of the reasons I'm going to make you do the option pricing model in the final exam. It's your rite of passage. If you can't pass it, you're sunk. Right? Not quite, no, but at least on that problem you're sunk. But you plug it in, it's mechanical. You just have to remember where the log button is, where the exponent button is on your calculator. You'll find it if you keep looking. Right? Sometimes it's the same button. You've got to hit something twice to get there. But if you plug the numbers in, you get D1 and D2, and N of D1 and N of D2. Remember how we described N of D1 and N of D2? They look like probabilities, right? They're between 0 and 1. N of D, if you look at the cumulative normal distribution, N of D is always a number between 0 and 1. And in fact, N of D2 has this very special meaning attached to it in option pricing. It's the risk-neutral probability that S will be greater than K. What's S here? The value of the firm. What's K? Face value of the debt. So based on my numbers, there's a 63% chance that the value of my firm will be greater than the face value of my debt, which means there's a 37% chance of what? What happens when the value of your firm is less than the face value of your debt? You're technically bankrupt. There's a 37% chance of bankruptcy. There's an outfit on the West Coast called KMV. It's been around a long time. And what they do is they offer this service to banks. So banks can come in with a loan portfolio and offer them the loan portfolio, and KMV tells them the probability of default on that loan portfolio. Big number for banks because that's how they set aside provisions for bad debts. And you know how they do it? They run an option pricing model. They get N of D2. And of course, they have a pretty sophisticated model to run it on a loan portfolio. And they take 1 minus N of D2 because that's what the default is, and they give that to the bank. You are using the option pricing model to estimate a probability of default. So as an equity investor, there's a 37% chance that you will default. But if you work the numbers through, the value that I get for the call option here is 75.94 million. You know what that is? That is the value of the equity in the company, which means the remaining 24.06 million is the value of your debt. And remember, it's one nice zero coupon bond. So if you know the face value of the bond, which you do, and you know the value today is 24.06, you can solve for the interest rate, and the interest rate on this debt is 12.77%. What's the risk-free rate, at least in this example? It was 10%. So your default spread is 2.77%. A few years ago, I read actually a working paper. I don't know whether it actually made it to publication that somebody in finance had worked on, where they tried to use the option pricing model to estimate default spreads and compare them with the default spreads you get by using bond ratings or the other approaches. And at least this paper found that the option pricing model gave you better estimates of what the default spread would be for companies than using traditional bond ratings or traditional ways of coming up with the likelihood of default. So with that limited information, I've told you what the value of equity is. So let's assume that you listen to me and say, okay, that makes sense. We'll pay 75. So you pay 75.94 million for the equity. Tomorrow you wake up to some catastrophic news. Half your company has disappeared. You think, how does that happen? You have two factories, one in Florida, one in California. Neither is insured. Take your pick. Earthquake or hurricane, one is gone. Half your company is gone. This is not good news for anybody. But I have a very simple question about mechanics. Remember, your value of equity was 75.94 million before this happened, right? Now I've dropped your value as a company by 50 million. We know the value of equity is going to drop. But my question is about how much. So here are your choices. It can drop by exactly 50 million. After all, you just lost 50 million in value. So that's the first. It'll go from 75.94 to 25.94. The second is that it'll somehow drop by more than 50 million. Why? Because your accountant comes in and says your book value turned negative, the equity is worth nothing, in which case you could lose all 75.94 million. And the third possibility to kind of round out the choices is you lose less than 50 million. You lose money, your equity drops, but it drops by less than 50 million. So what do you think is the most likely outcome? 50 million, more than 50 million, less than 50 million? If it's less than 50 million, you better fill in the blank for me, because if it's less than 50 million, somebody else is, losses have to be borne by somebody. So if you bear less than 50 million, who's the only other player in the game? It's the lenders. You guys don't want to be part of this party. But guess what? I'm going to suck you and say, come on in. I said, no, I don't want to be here. No, come on in. Be a sharer. We have a loss here. You take a portion of the loss. And that's exactly what you're going to see when you play out the option pricing model, is I plug in the values in the option pricing model. The only number that's changed actually is S, right? Everything else is pretty much the same. T is 1 day shorter, but not 9 years and 364 days is close to 10 years. Everything else stays the same. Remember again, your value for equity was 75.94 million. With these changes put in, let's see what happens. The value of equity drops to 30.44 million. You're saying, this is awful. Your value of equity dropped by only 45.5 million. Why only 45.5 million? Remember, the total loss was 50 million, which means the remaining 4.5 million was borne by you. Your debt is now riskier. How much riskier? What was the default risk before this happened? Do you remember? It was 37%, right? If you remember, the number was 63 and 1. Now think about what the risk of default is. It's gone up to 58%. And that shouldn't be surprising. If your company is worth half what it was before, you still owe the same debt. Your probability of default went up. And once I got started on this process, I couldn't stop myself. I dropped to 50, to 40, to 30, to 20, to 10, to 5, to 3. You know what I wanted to find out? When does equity become worthless? It's kind of a perverse exercise. But when do people just give up on equity? And I could not make equity go away. It is an incredibly stubborn instrument. I made the value of the business 1 million. You still owe an $80 million bond, and the equity hung in there. So if you ask anybody to look at this company, it'll be worse than MoviePass. And I don't think, the parent company for MoviePass, I think a share is now 0.0036 per share. This is one of the few companies you can actually buy 1 million shares. Don't tell anybody the price you bought it at. Just say, I own 1 million shares. Don't mention the company name. It's your one chance to buy 1 million shares. But this is a company with the equity that's... So what's keeping equity afloat here? It can't be expected cash flows. It can't be some pricing justification. What's keeping equity afloat? So what is it? One is volatility, but that's only half the picture. If all it was volatility, the value would... Volatility plus time. Right? There are two things going for you. One is you have 10 years. If you had only 1 day, the value of the equity would be worth nothing. But you have 10 years and you have volatility. So it's investing on a hope and a prayer. You hope and then you pray and then you hope and you pray. And most of the time when you hope and pray, nothing happens. It's a deep, deep, deep out of the money option. It gave me an entirely new perspective on what it means to be bankrupt. I used to think bankrupt meant that the value of your assets was less than the value of your outstanding liabilities. But my daughter taught me different when she was 3. She's a financial genius. Not really, but no. And so when she was 3, I don't remember what was a summer where I probably had nothing to do. I used to play Monopoly with my sons, my 2 older sons, every afternoon. And Monopoly, if you've ever played, is a game that never ends. Yeah, you go on and on and on. And she wanted to join it because it looked like we were having fun. We were putting on a pretty good act. So finally, she was very persistent. Tiny little creature, but very persistent. So finally we let her in. And she was like a one-person Enron. She would collect 200 when you did not pass go. She'd put hotels and properties that didn't belong to her. She'd charge you rent every time you passed by. You just went by me, give me. And finally I had to ban her. I said, Kendra, you're banned. She's a horrible temper. Tiny person, horrible temper. Don't ask me how that happened. She starts walking and says, you're bankrupt, you're bankrupt. I'm very impressed. 3-year-old using the word bankrupt. I said, Kendra, what does bankrupt mean? Expecting an answer like the value of your assets is less than the value of your outstanding liabilities. And she said, bankrupt means you don't get to play the game anymore. And you know what? It's a perfect definition of bankruptcy. Because as long as you get to play the game, you are not bankrupt. That's what's keeping equity afloat. You're not bankrupt as long as you continue to control the company. Equity will stay afloat. So when you think about equity in deeply distressed companies, you're starting to see essentially the equity behave like an option. And I'm going to use that implication to draw as much out of this as I can. So think of the example, let's revert back to the original $100 million value. Remember what the equity was worth? $75.94 million, right? So let's assume that you've computed the $75.94 million and the debt is worth $24.06 million. I'm going to play the role of a project salesman. And I'm going to show up at your door and I'm going to try to sell you a project. Let's see if you buy. So I walk in and say, I have a project for you. Being well versed in corporate finance like you are, what's the question you ask me about the project? What's the net present value? As it's minus 2 million. You get ready to throw me out because in corporate finance we're taught don't take negative net present value projects. No, before you throw me out, I have to add something about this project. Not only is the net present value negative, it's a very risky project. This is going from bad to worse, right? You take a negative net present value risky project. In corporate finance, you'd be banned for life. But let's see what happens in this company when you take a negative net present value project that is very risky. First, remember the value was 100 million before you took this project? When you take a project with a net present value of minus 2 million, what happens to your value as a company? Value is additive, so basically your value will go from 100 to 98 million. See, I told you so, don't take the project. We're not there yet. 98 million is now your new value for the firm. But remember, it's a very risky project. So what did it do to your variance in firm value? It went from 16% to 25% because you took a project that made your entire company much riskier. You're the equity investor. Your firm has become less valuable, but it's become more risky. Let's see the magic here. If I value the equity, now remember it was worth 75.94 million? By taking a bad, risky project, what have you done to your equity? You've increased it by almost 2 million. You're saying, how the heck did that happen? It's very easy to explain. How did it happen? Who got ripped off here? The bondholders or the lenders. You know the lesson I draw from this? If you're a bank, never lend to equity investors in a levered transaction and let the equity investors run the company. You're begging to be taken to the cleaners. Because as a banker, you lend to an equity investor in a highly levered transaction, he's going to run the equity like an option. He's going to take riskier and riskier and riskier projects. And you're going to be end up holding the bag because you are the one who lent the money. So if you lend money, what should you do? Have veto power over bank. You should be involved in the project choice because leaving it to the equity investors will essentially mean they're going to transfer wealth from you. Next LBO transaction you do, look at the list of banks that are involved. There'll be a whole bunch which will just lend money to the LBO because of the reputation of the equity investor. You can't do that because you created a conflict of interest here between the lenders and the equity investors. Any questions? Yes?
But don't the bondholders have the advantage of convergence? This you are giving them the 10-year timeline.
Well, convergence on a bankrupt company is essentially going to not help you, right? If the company survives and makes it, you'll get convergence. But the worry here is if I take enough risk, I get the upside, you get the convergence. What's the best that can happen to you? You get your money back, right? Yeah. But that's not good enough because during the 10 years, I essentially took advantage of that to get all the upside. So basically what I've had is the upside and left you with the potential of you might never make your money back. I mean, you might, if you live through, you're saying, I don't care. But a lot of the time, you're not going to live through because I'm essentially, and especially as I get more and more levered, the more you have to worry about, hey, how much risk are you going to expose me to? The analogy I would give, it's like a casino gambler who loses all his money, all his wealth, and then the casino lends him $500,000. He said, play carefully with that money. Are you going to play carefully? You're already bankrupt. What difference does it make? Bankrupt with 100,000 in loans or 600,000? So you guess what you're going to do? You're going to take all 500,000, put it in a number 23, and if it pays off, you're out of the problem. If it doesn't, you are bankrupt anyway. That's effectively where you're going to end up with highly levered companies with the equity investors running, is they're going to take the biggest bets they can because they need that upside to get out of it. And the deeper the hole, the more risk they're going to take. So let's take another, something we take for granted in finance. In finance, the old proposition is if you pay fair value for something, it's a zero net present value transaction. Let's see if that's true. So let's revert back again to the original example. Remember you had a $100 million company, your equity was worth 75.94, Let's assume you do an acquisition of a larger company, a company which you valued at 150 million, but you pay 150 million. It's a fair value acquisition. It's 0 net present value. So your equity should not change, right? At least that's what I was taught in finance. You do it in a 0 net. Let's see if that is true in this case. You buy a company, you pay fair value. Let's work out what the numbers look like. There's your firm. There's the firm you bought. But I did not mention that no two firms in the market ever move together. They're not perfectly correlated, even if they're in the same business. But let's say they're in two different businesses here. Let's say that the correlation between these two companies is 40%. You're saying, who cares? Remember that when you start finance, you do that equation for two asset portfolios. The very start, you must have done this in foundations. What's the variance of a two asset portfolio? It's a variance of asset A times the weight of asset A squared, variance of asset B times weight of asset B squared, and then there's a third term. And what's in the third term? 2 times weight A, weight B times the covariance between the two, right? And that's basically what I did. I looked at the variance of the combined firm afterwards, and there seems to be some magic that happens here. I bring together two firms. One has a variance of 16%, the other has a variance of 25%. The combined firm has a variance lower than either firm. But it's not magic. We see this in portfolio theory all the time. But here's why it matters to you as investors in the company. Remember the equity that I valued at 75.94? And if I value the equity in firm B, it'd be what? The combined firm's equity is worth only 207.43, which is about $3 million less than the equity in either of the two companies. What happened here? You combined two companies, you paid fair value, so why are equity investors worse off after the transaction? The combined company is not worse off, but why are equity investors worse off? Lower volatility, but in terms of mechanics, why is that lower volatility? I thought that was a good thing. Less upside, but that's really not why, because I've already put that into should have put that into my valuation, right? My betas will be lower, my cost of equity will be lower. I'm sorry? I won't even bring that in, because this is exactly why the size premium never made sense, right? Because if there is a size premium, there's a simple way for me to create value. What do I have to do? Bring two small companies together, make them a larger company. Magically, the size premium goes away. We know that doesn't happen. So I don't even have to bring the size premium in. It's a much simpler, much more immediate effect. Where's the increase? Where's the decrease in value come? In the total value of the companies don't change, right? So what's happening? Value is being transferred from the equity investors to the lenders. Why, as lenders in these two companies, do you wake up the day after the merger feeling much better? Because before the merger, what were you doing? You were lending to two risky firms. Now you're lending to a much safer firm, and you're still charging the same interest rate you were before the merger. Guess what's happened? The lenders have gained in value because your company got safer. This happens in conglomerate mergers all the time. But there's a way in which your equity investors can claw back that increase in value. What's the first thing you can do? If you know this is going to happen after a merger, what should you as equity investors do when you're planning to bring together two companies in different businesses? First is you can renegotiate with the lender saying, hey, after this the company is safe. But what if they refuse? They say, we have a contract here. Look, the contract says 8%. We're not changing. Let's say they don't let you pay down debt. In many countries, you're not allowed to repay debt ahead of time. You can be locked in. So one by one, I'm taking away. So that's a good thought. If you can renegotiate with the debt, you'd like to make the interest rate lower and get the value back. But if they refuse, there's another way you can still get it back. When you did the acquisition, did you set the financing mix on the acquisition? Yeah, you decided how much equity and debt to use, right? So guess what you should do? Use more debt on the, because in a sense what you're doing is you're saying, look, you guys want to negotiate with me, I'll make your debt riskier. All I have to do is borrow more money, and so if you're doing a conglomerate merger, you actually should increase debt ratios over time and it's not pushing it above your optimal. Your optimal debt ratio will actually get to be higher for this combined firm because you have more stable and predictable income and therefore can afford to borrow more money. So when you think about distressed equity, those are factors that come into play, and they can affect how we think about decisions in corporate finance and consequences. Question? No. So let me go back to that hypothetical example. I gave you a lot of stuff that you wouldn't get for a real company. In fact, no, I don't know whether the person who brought this up last week, the Monday, somebody was talking to me about their company, and I'm trying to see the person is there. I don't see the person. But their company has 97% debt, 3% equity. It is truly a basket case company. It's lost money, its book equity is turned negative. Pretty much everything you can think of that's gone bad has gone bad. But the equity is still trading. So when he did his DCF value, he plugged in assumptions the company would make it, came up with the value for the assets, but the value of the assets was less than the outstanding debt. So the DCF value for the equity was negative. So at least from a DCF perspective, the equity is worth nothing. He tried pricing the company. No equity multiple worked because there's no net income. So he used an enterprise value multiple for the sales, because sales was the only positive number. Came up with an enterprise value, which was still lower than the debt. So the pricing said the equity is worth nothing. So he's pretty frustrated because he's saying my DCF model gives me nothing. My pricing gives me nothing, which left the open question of should I just throw in the towel and say the company's worth nothing. And I said, hold on for this session, because maybe there is a glimmer of hope here. Because the people buying stock in this company are not buying it for the cash flows. They're not buying it for the value of future going concerns. They might be buying it for the same reasons you're buying a deep out of the money option. So for some of you, this is going to be perhaps the only way you can get value for your equity. And if you're going to try to apply this in your company, and you look back at my hypothetical example, you're going to start to run into some issues. First, in the hypothetical example, I started by giving you the value of the firm up front. I said the value of the firm is 100 million. You're almost never given that, right? In a regular valuation, you don't know what the value is. You know the pricing in the market, but you don't know what the value is. So I gave you the value of the firm. I gave you the variance in that value. You're saying, can't I look up the stock price variance? This is a variance in the overall value of the firm, not just the stock price. I gave you the life of the bond, and I made it a nice convenience. How many troubled companies do you know of that have one nice zero coupon bond with a 10-year maturity? If you're a troubled company, guess what? You borrowed money from anybody who will lend you money. You got like 50 different debt issues, all with different terms. So the original example I gave was almost completely impractical. But I want to try to use it to value equity in real companies. So what I'm going to try to do is actually try to come up with the inputs for a real company so it looks like my hypothetical example. So let me start with the firm. I want a value for the firm. So that 100 million that I gave you, how would I get that for a real company? And here are your choices. When you do a discounted cash flow valuation of the firm, you take free cash flow of the firm, you discount back by the cost of capital, that DCF value becomes the basis for your value for the firm. You can use that. That's your first choice. If you're in a hurry and you want to do this for a company, you might say, look, I don't want to do a DCF. Your second is to do a pricing. Take an enterprise value to sales, come up with a value. So the value of the firm you can either do by doing a DCF or a pricing, but that'll become the S in the model. In fact, if your company is in multiple parts, remember the liquidation valuation we talked about? You can do a liquidation value of the parts. But the S in the model is going to come from something you've already done. So if you've done a DCF of a company, that DCF can become your S. For the variance in firm value, I'm going to be stuck. If I go to Bloomberg and look up the variance, it'll give me a variance in the stock price, as I said, but not a variance in firm value. I'll give you the easiest way first and then circle back to it after I've given you the other choices. You're valuing a troubled steel company. Troubled in what sense? It's losing money, its book equity is negative, its equity is starting to behave like an option. And you want a variance in value. How do we get the beta for a company? We looked up a bottom-up beta, right? We looked at other companies in the business, we looked at their betas, we used the law of large numbers and said that's a beta. If you go to my website, I have variances in firm value by sector. And it's not magical. I collect the stock price variance. So essentially, I do this for companies in every sector, and I have a variance in firm value for steel companies. I'm going to take that variance. It's a bottom-up variance. So basically, doing a troubled company, you can take the variance of the sector and make that the variance in your option pricing model. That's the first choice. In my view, it's the easiest choice. Here's the second. Remember we did Monte Carlo simulations when we did Royal Dutch, the oil price changes. Let's say you're valuing a troubled shale oil company. Right now, the enterprise value is less than the outstanding debt. Many of the shale oil companies are hopelessly over-levered. One way I can get a variance is I can make the value of the shale oil company a function of the oil price, build in that simulation. And what you get as output from the simulation, you get an expected value, which is the S in the model, but you also get a standard deviation in that number because you run these simulations. You can use that as your standard deviation. Slightly messier because you have to do a Monte Carlo simulation, but not that much more difficult if you're willing to make some assumptions. Yeah.
How do we know the distribution of the inputs?
For all you had was oil price, right? Because if it's more complicated, then obviously then you'd have to decide whether it's worth it. But if it's an oil company, it's oil price, it's going to be, so if you have a troubled commodity company, which often is a pretty big subset of troubled commodity, use the commodity price and make that. And there's a third way to do it. Let's say you have a company where both stock and bonds are traded. You can look up the standard deviation in stock prices by going to Bloomberg. It's a traded asset. You get a standard deviation in stock price. You can go to the bond market and look up a standard deviation in the bond price. In fact, Bloomberg gives you standard deviation in bond prices. So you have stocks and bonds. I've got the standard deviation of each. Let's say you're 10% equity, 90% debt. The reason is you're distressed. Your equity is a tiny percentage. Your standard deviation in firm value will be essentially, remember that two-asset portfolio? I'm going to use that using stocks as asset 1 and bonds as asset 2 and looking at how stocks and bonds move together. If you're a troubled company, they're going to move together a fair amount, but not perfectly. I get a standard deviation firm value. That requires that stocks and bonds be traded and that you compute a correlation between the stocks and bonds of that company. I almost never go there. I'm too lazy. But if you had a company where both were traded, that's what you could use. So that's going to become my variance in firm value. So instead of giving you a 40%, which is what I gave you as a standard deviation, you compute it yourself. So I've got the S, I've got the sigma. Let's move to the debt. As I said, no troubled company in history has ever had one nice zero coupon bond. So here's what I'm going to do. I'm going to take all of the different debt issues, which might be 50 different debt issues. I'm going to add up the face values of all of the debt and even throw in the interest payments. Collectively, I'm going to say this is how much money I owe on my debt. And I'm going to make that the face value of a zero coupon bond. Then I'm going to take a weighted average of the durations of each of my debt. Remember, I can compute the duration for debt 1, debt 2, debt 3. If you're in a hurry, take a weighted average of the maturities. It doesn't matter that much. And I'm going to make that the maturity of my zero coupon bond. So what I'm going to do is take all your complicated debt and replace it with one hypothetical zero coupon bond where the face value is going to be equal to the debt payments due on all my debt, and the maturity is going to be the weighted maturity of all of my debt. It's starting to look more like my hypothetical example, right? That's going to give me the life of the option. It's going to give me K. And I'm going to pick a risk-free rate that matches that life, because that's what you need in an option pricing model. When I plug the numbers in, I should be able to come up with the value of the equity. So I'm going to illustrate this with the real company. Okay? This is this hole in the ground where cash goes in but never seems to come out, called the Eurotunnel. Originally, when the Eurotunnel was conceived, it was going to be this big cash flow generating business. It's never made money. So this was at perhaps one of its different floors. In 1997, Eurotunnel had earnings before interest and taxes of minus 56 million, net income of minus 685 million. So check one. They're losing money? Yes, they're losing money like crazy. Their book equity was minus 117 million. What does that tell you? They've been losing money for a long time. Check box 2. So they're losing money. They've lost money for a long time. Let's get check box 3. They owe about 8.9 billion pounds in debt. Check 3. They owe a lot of money. And the debt is really, really long term, a lot of it. So the weighted average duration of all of their debt is about 11 years, and collectively they owe about 8.9 billion. So check 1, they're losing money. Check 2, they've lost money for a long time. Check 3, they're going to continue to lose money. And check 4, they owe a ton of money. Would you buy equity in this company? You're saying, God, no, not as a cash flow generating asset, unless you like large negative cash flows. So let's see how this would work if you were trying to use the option pricing model. Remember, to use the option pricing model, you first have to do a DCF. You can't just jump directly in because you need the DCF as an input into your option. It's not an either or. You have to start with the DCF. So the first thing I did was I did a discounted cash flow valuation of the Eurotunnel's assets, which basically is the cash flows collected in the tunnel assuming things, the margins improve. So this is assuming that they get nurtured back to health. The value that I got was 2.3 billion pounds. How much do they owe? 8.9 billion pounds. So if the value of the assets is 2.3 billion pounds, you know you're deep underwater. Right? So I've listed out the assumptions I make, and the assumptions I make assume that they will come back to health and they'll become a going business. But I still have a problem. My value for the assets is 2.3 billion. I owe 8.9 billion. Now to get the variance, I tried to look at other companies in the sector. Unfortunately, this was a one of a kind in 1997. So here I had to look up the standard deviation, the stock price, and the standard deviation, the stock price was 41%. I looked up the standard deviation, the bond price. It was also traded with 17%. And this was one of those cases where you could look up each easily. And I also computed the correlation between those two was 0.5, which is high by typical corporate standards, but when you get distressed, your bonds and your stock tend to move together. So your correlation was 0.5. And most of the company was debt. It was 85% debt, 15% equity. If that equation looks foreign to you, it's because you've forgotten your first equation from, that's just the two asset portfolio. Weight of asset 1 times the variance of asset, so that's the equity. Weight of asset 2, that's the debt times the variance of debt, plus 2 times weight 1, weight 2 times the covariance between the two. I come up with a variance in firm value of 0.0335. I think I'm ready, because when I put the numbers in, here's what they look like. So this is my Eurotunnel version of the hypothetical company we did. The S is the 2.3 billion that came out of my DCF value. The K is 8.9 billion. That's the debt that I owe. The weighted average duration on my debt, 10.93 years, becomes the equivalent of the life of the option. The 0.0335 becomes the variance in that value. And I look up a risk-free rate corresponding to the life, and that's always the rule you follow in option pricing, about a roughly 11-year risk-free rate. I plug the numbers in. I get D1 and D2, N of D1 and N of D2. We pause right there. What is the chance that Eurotunnel will default on its debt? 9. No surprise here. This company is a basket case. This is confirming for 92.5% chance of default. But here's the magic. Here you have a company which is deep underwater. There's a 92.5% chance of default. And when I plug the numbers in, the value that I get for the equity is 100. It's not 0. I'm still willing to pay for the stock. Why? Because I have a lot of time and I hope that something good will happen. Most of the time when you buy deep out of the money options, nothing good happens. You lose everything you invested. But when something good happens, what you make is 10,000%, this is a heavily skewed payoff. I mean, have you heard of vulture investing? What vulture investors do is they buy distressed companies, distressed bonds, distressed equities. But there are vulture investors who buy just distressed equities. They don't buy them for the cash flows. They don't buy them using a dividend discount model. They buy them using the argument that these are options, and all I need is a few options to pay off big time for my overall portfolio to look good. So let's say you take this to heart. You decide to become a vulture investor. Help me out here as to what kinds of distressed equities you're going to buy. And I'll give you your choices. Would you rather buy distressed equities in very stable businesses or distressed equities in very risky businesses? You don't want to buy deeply distressed stable companies. I don't even know what that means. I lost 200 million. I can guarantee you I can lose 200 million for the rest of eternity. Who wants that? So once you get deeply distressed, risk is now your ally. The most you can lose is what so you want deeply distressed, risky businesses. Would you want companies with a lot of long-term debt or a lot of short-term debt? Why? Because you want time as your ally, right? So you want deeply distressed, risky companies with a lot of long-term debt. Hey, you've got capital IQ. When do you go to do this? In fact, I just did this for about 10 minutes before I came into class. I was saying, let me find the name of a company. I could use, again, MoviePass, but that's so deep out of the money, I don't even know where to go with it. But you take Tenet Healthcare, right? I'll give you what makes me think about this as an option. Their market cap right now is about 2.2 billion. They owe about 15 billion in debt. Okay? Their book equity is negative. They lost money last year. You can do a DCF if you want in Tenet Healthcare. My guess is you're not going to get to 15 billion. that DCF value of your assets is going to be less than 15 billion. It is going to hit that point where it very quickly stops being traded as a stock, and maybe it's done it already. I don't think it's quite reached that point, but it's getting very close to the point where you're going to get that. And when it happens, it's actually going to shift everything on its head, right? Risk no longer is a bad thing, it's a good thing. It might not have happened with Tenet yet, but it's getting awfully close. About 6 months ago, I valued Jet Airways, which is an Indian airline. For those of you who know, it's a company that's past, basket case. Yeah. But it's been approaching that, and you could say this about a lot of airlines around the world. The value of the assets is less than the value of the debt, but the equity will continue to trade, and trades for the same reasons. Deep out of the money options continue to have a price. So again, even if you never use the option pricing model to attach a value to distressed equity, the value is there, and you have to think about what it means from investing, because these options clearly have significant economic value, and it comes from that option to liquidate. Let me be quite honest, every company has this option to liquidate in there. But if you're a going concern, the value that you get as a going concern is so much higher than the option to liquidate, you never even look at it, right? So if I computed an option to liquidate Microsoft today, I'll come up with a value, but it'll be a fraction of what you get of Microsoft as a going concern. So for most companies, the going concern value is so high, we never care about the option to liquidate. It's as that you get into more and more trouble and you owe more money. So you need that combination. Without debt, there is no option to liquidate. So if you get that combination of a money-losing company where there is very little light at the end of the tunnel and you have a lot of debt, a lot of retail firms in the US are very quickly approaching or have reached option pricing status, right? I mean, Sears and obviously it's gone past that status, but look at a JCPenney. My guess is you're at this point buying more option than traditional discounted cash flow valuation. That option might not pay off, but that's the nature of deep out of the money options. Right? So the key here is to recognize that there are options all around us. Most of them have no economic value, you can ignore them, but if they do have economic value, it comes from that word exclusivity, then you got to try to attach at least a premium to them and think about how it affects your decisions as an investor. Any questions about real options? Right? So don't get intimidated by option pricing models. As I said, even if you never ever use an option pricing model to value a real option, just recognizing when there's a real option. And to me, that's exactly what people are talking about when they talk about the value of platforms, the value of big data. Bringing in the technique, the tools from option pricing can let you decide when it makes sense to talk about big data, when it makes sense to pay a premium for platforms, because you have, in a sense, the key questions to ask to kind of extract that value. So let's talk about acquisitions. I'm going to set up this process, and then I'm going to send you a test before the next session, because the title of the section should kind of give away what I think about acquisitions. About 15 years ago, a friend of mine who runs the CEO seminars in New York called me and he said, can you come in and talk? I have a seminar of CEOs that I'm bringing in next week. And I said, what are you going to talk about? He said, acquisitions. And he said, are you sure you're talking to the right guy? Because you know what I think about acquisitions. I think they're the single most destructive act in corporate, when you think about corporate actions, because you can wipe out 20 years of good work with one bad acquisition. So he said, are you sure you... Because this was a seminar, for lack of a better word, serial acquirers. These are companies that do acquisition after acquisition. He said, no, I want you to come and talk at the end of the day, because for the rest of the day they're going to be hearing from bankers. And what do bankers think about acquisitions? It's like mother's milk, right? You can't live without it, so you have to do more acquisitions. He said, I'd like you to come in and be the counter. And I said, I'm glad to be the counter. And I came in and I put up my first slide. And my first slide kind of captures why I find acquisitions so troublesome. I think acquisitions are an addiction. That once you start growing through acquisitions, it's very difficult to go back to taking internal projects because they look like so much work. And you don't get the glory and the ego boost you get from acquisitions. So I'm going to start out with the bad news about acquisitions first. The bad news about acquisitions is there's usually a winner in acquisitions, and it's usually not the acquiring company. So let's think about the two big themes, right? You have an acquisition being announced right now, Anadarko. Occidental and Chevron are fighting over it. We'll talk about who the winner and the loser really will be in this bidding war, and it's going to surprise you. So you have an acquiring firm and a target firm. So what this chart looks at is what happens on the acquisition date to the target firm and what happens to the acquiring firm. So the red line is the target firm. Day 0 is the actual announcement of the acquisition. So in theory, nobody knew about this acquisition before day 0, in theory. You see why I said in theory? Because it looks like there's a little drift up in the price. I'm sure this is because markets are so clever, they can foresee all kinds of things. Or the more cynical explanation is, somebody knows and somebody... This is the best... I mean, if you want to see whether there's insider trading, don't look at whether the SEC actually catches anybody. All you need to do is look at the drift in the price before news stories, and you know that somebody is trading. So clearly there's some leakage. That doesn't surprise me. But the bottom line is, if you're a target company stockholder, you love the acquisition process, because you open up the newspaper, what do you discover? That your stock went up 25%. So if there's a winner in there, it's acquiring company stockholders. And if there's a loser, it looks like, at best, it's target company stockholders. And if there's a loser, if you look at acquiring company stockholders, at best they break even, but it looks like on average they tend to lose money. You're saying that's not very much money. What you have to factor in is a typical acquirer is often 10 to 20 times larger than the typical target company. So in percentage terms, you losing 2% of your value and the target firm making 20% might actually even out if you're 10 times larger. So on average, acquiring companies don't do very well. And I'm trying to couch this in as diplomatic a way as I can. And target company stockholders do really well. But of course, if you present this evidence to managers, you know what their response is? They don't see what we see. They don't have access to all that synergy and all the neat stuff. We have the tables, we've done the... And let's start with the truth. Managers do know more about the acquisition than investors do. So their reaction is they don't have the information. Okay, so maybe markets are just wrong in the acquisition day. There's a way to check this, right? You can track acquisitions 5, 10 years after, and if you're right about synergy and control, what should you see? You should see the evidence of that in the numbers. And McKinsey and KPMG have both looked at the aftermath of mergers, and it's not pretty. If you look at McKinsey, for instance, on mergers, asks 2 very basic questions. The first is, did the return on capital on this... Remember how with projects we said is the return on capital greater than the cost of capital? Very basic. They asked the question about acquisitions. The return on capital in acquisitions exceed the cost of capital? And they also asked the question, do these acquisitions help the parent companies margins go up? Because ultimately, we're talking about synergy. You should see it as higher margins, higher returns. And most of the companies they look at failed at least one test, and many of them failed both tests. So that's from, McKinsey's done that multiple times, and every time they find the same thing. So it's not as if things are different now than they were. KPMG did this huge analysis at the end of the 90s, thousands of mergers. And they focused in on that one word that you see used over and over in acquisitions, which is synergy. And they asked a very simple question. In what percentage of mergers does synergy actually show up? You're saying, how do they capture that? They just combine the earnings of the company, and if there's synergy over time, that combined company's earnings should grow faster than the individual companies or the margin. So basically, they were looking for, hey, does the synergy show up? In 83% of mergers, they found either no synergy or reverse synergy. You're saying, you know what reverse synergy is? 2 companies that are making a lot of money come together, create a combined company, and magically the combined company stops making money. It's not your end game, but whatever reason, cultural issues, 2 companies couldn't get together, something bad happened. In about 1 in 6 mergers, synergy shows up. Mark Sorower used to teach in the strategy group here. He left, I don't know which consulting firm he joined, but he wrote, a long time ago, 20 years ago, he wrote a book called The Synergy Trap. A strategy person writing that book, I think, gets banned from the strategy fraternity entirely, because synergy and strategy is just, let's talk about it. He called it the synergy trap because the company after company, he used to do consulting with the companies that did M&A, and he discovered company after company he worked with, people talked about synergy at the time of the merger, but it never seemed to manifest itself. And the scary thought here is the disease is spreading. If you think this is some US-centric problem, you might want to let that go. For a long time, if you're an emerging market company, you are on the right side of this divide. You know why? Because until about 20 years ago, if you're an emerging market company, usually the target company is usually some rich US company, European companies with the acquiring company. So about 20 years ago, if you're an Indian company or a Brazilian company, you're usually the target of an acquisition. Well, the tables kind of turned when market caps of Indian, Chinese. So now Indian and Chinese companies are acquiring companies, and this is actually a source of great national pride. Look, we're the acquiring companies now, we're buying. And you should always have mixed feelings about this process, because this is a study that looked at Indian companies that do acquisitions to see, hey, maybe Indian companies are different, maybe they're smarter, maybe they get synergy. So this looked at the months around the announcement. So there's the announcement month. And initially, things look really good. So when you see those numbers climb, initially right after the merger, people are excited. Indian company buys a British company. We'll push the Tata buys Cora Steel. Let's push up the value. This is good. And after about 6 months, you start to get the numbers rolling in. And as you track them through, by 20 months after the merger, you look at Indian acquirers, you see the same phenomenon that you do with US companies. Here's the bottom line. Acquisitions globally seem to destroy value. And here's the second bottom line. Things are not changing. These studies have been out for 30 years, right? If people are reading this, you're saying, why aren't they stopping? Why aren't they slowing down? There is no evidence that any of this is slowing people down. There's something, at least to me, wrong with this process. And we know what it is. There is a clear conflict of interest. And here's why. Let's play the game out. You're the acquiring company. You're the target company. It's a friendly merger. You guys are the bankers for the target company. You guys are the bankers for the acquiring company. There are 4 people in this room. That's all, right? Acquiring companies managers, acquiring companies bankers, target companies bankers, target company managers. Who in that room does not want the merger to go through? There's nobody. So guess what? There's nobody pushing back. You can make up synergy. You can pay 50% premiums. The process is screwed up. Okay? And I've said this in my corporate finance class. I'll say this here again. Asking a banker whether an M&A deal makes sense is like asking a plastic surgeon whether there's something wrong with your face. The answer you're going to get is always the same. Of course. Go ahead and do the deal. The process is screwed up because there is a clear conflict. Everybody wants a deal to go through. So with this group that I talked about, the serial acquiring CEOs, I offered them a deal that they refused to take. I said, look, let's accept the fact that acquisitions haven't worked, but you are special companies. You do the right deals. I'm going to put you through a 7-question test. And I gave them a leeway. I said, you can fail 2 of the 7, but if you fail more than 2 of the 7, I'd like you to stop doing acquisitions. None of them took me on the deal. But I'm going to take you through those 7 tests. Because how many people in this room are going to go into M&A? And so, are you willing to take the deal that if you fail 2 of the 7 tests, you're willing to reconsider maybe? I think you'll pass most of the tests anyway. So, but you're going to see that. So for the start of class next week, I'm going to send you the 7 tests, but I'm going to set up at least the 7 issues that I think are at the heart of why acquisitions fail. The first is what I call risk transference. It's something we've actually talked about off and on in this class, but it's going to get zoned in when we talk about, at least in the context of acquisitions, why it matters. You know what risk transference is? A safe acquiring company looks at a target company and thinks by acquiring the target company, it can give the target company its characteristics as a safe company. Right? Second is what I call debt subsidies. Debt subsidies occur because an acquiring company has access to a lot of cheap debt. Why? Because it's been built up over time. It has a great rating. It uses that cheap debt to do an acquisition, and it can, in the process, end up subsidizing target company stockholders. Again, we'll see this play out. Third is what I call autopilot control. Those of you who work in M&A, you know what the rule is, right? Do your valuation and then add, remember that example? Add 20% for control. We're going to see where the 20% comes from and why it's such a shaky number. Why that 20% makes absolutely no sense. We've kind of talked about it before, but we'll come back and nail it down. Fourth, we're going to talk about synergy, but we're going to keep an open mind. We're going to say, okay, where does synergy come from? We're going to try to value synergy, and then we're going to find the source of the problem. It's not that synergy doesn't have value, but if you pay twice whatever that value is, you have a problem. It's not that you don't have value from synergy, but if you overpay for it, it doesn't matter that it's there because the acquiring company shareholders don't get it. Fifth, we're going to talk about how pricing plays out in acquisitions. There's a lot of pricing, right? You get an EV to EBITDA multiple. You know where the EV to EBITDA multiple in a lot of M&A transactions comes from? It comes from looking at comparable companies with transaction multiples. You're saying, what are transaction multiples? What are transaction multiples? It's not just what people are paying for regular companies, it's what people pay on other acquisitions. Talk about feeding dangerous trends into your numbers. If everybody overpays, you're going to overpay as well, because you're told if you don't do that, you will not be able to do acquisitions. The sixth is something that I remember from Alice in Wonderland, where Alice wanders into the Queen's court, and the Queen says, verdict first, trial afterwards. A lot of acquisitions, people decide how much to pay, then they go looking for justifications for that. So the decision's been made already, might as well not fight it, so you facilitate it. And finally, it's amazing how you can make a $3 million mistake and get fired, and you make $3 billion mistakes and you get promoted. There's something about the acquisition process where nobody seems to be held accountable. I'm going to take you to the example of HP, which bought Autonomy, wrote off $8.5 billion, and nobody at any part of the process, the bankers, the accountants, the managers, nobody lost their jobs. Nobody had to give back their premiums. There's no accountability built into this process. So we're going to talk both about the mechanical problems in the process, as well as what I think are the structural problems in the process, things that need to be fixed for this process to actually make sense. To begin with, I don't think the deal makers should be the deal analysts. If you're a banker, you have a skill set. You provide me with the deal specifics. But you shouldn't be the one telling me whether the deal makes sense. That makes absolutely no sense to me. There is an opening here for a process that's cleaner. It doesn't mean mistakes are going to stop. You still have egos involved. We're going to see what kinds of companies tend to do the most acquisitions. And it usually turns out that it's not the company, it's the CEO of a company. It's the acquisition bug goes with the CEO, not with the company. That CEO moves around, the acquisition process tends to follow. So we'll look at what kinds of CEOs tend to do acquisitions. And there's a lot of behavioral evidence starting to accumulate on the personalities of CEOs who tend to do acquisitions. And they're the personalities we prize. They're bigger than life, they tell big stories. And they tend to be overconfident people. They're the kinds of people you hated in high school. Once a doctor they own the world, and actually they did own the world. They kind of owned at least that high school world. They're the guys who rise to be CEOs or acquisitive CEOs of companies. So not surprisingly, they bring that same character set into place. So next session, I'll send you that pre-class test. If you get a chance, try it out. It'll take you about 5 minutes. It's a great way to kind of see the mechanics of M&A valuation. Yes.
Just a quick question. I'm just wondering, because normally on the quizzes we get 30 minutes for 3 questions. So is it
These are long, multi-part questions. I think the last 2 finals have shifted to 8 questions.
okay?
So there'll be 8 smaller questions, because the 5 questions have 4 parts usually to them. They're more involved, but they're divided.
So like from a time perspective, do you think that will feel as crunchy as on the quizzes?
Because you have the luxury. The reason you won't feel as crunched is if you can get 1 or 2 questions done quickly and out of the way. So you have more time to play with. You can spend more time and be able to recover.
Okay.
Because you have more time to play with.
Awesome. Okay, thank you so much.
Hi, how are you? The exploration cost?
Exploration costs.
That's why I thrown in there. I mean, because the exploration costs are fairly small, yet reserves are so large, and I feel like the optionality of the reserves is significant to bring this to play.
Yeah, I would bring in the optionality. Because the more in the money the reserves are, the less the optionality, right? So Aramco, for instance, the optionality is less than for a shale oil pipeline. Because the nature of options is, as you get to close at the money or out of the money, the premium becomes a bigger factor. So I would check what the development cost on the reserves is. If it's well below the oil price, putting in an option pricing market is not going to help you that much anyway. But if there are parts of the undeveloped reserves, and that's the problem, is they have to report only viable reserves. And to the extent that there are other reserves they own that they're holding back from you. I wish they do, because I don't think it's their fault. It's the way the accounting disclosure is written. But if you can find any information about the non-viable reserves, that's where the optionality is going to be greatest.
Yeah, so when I was going through, I saw the friendly example resources in their accounting, particularly on their financial reports, a lot of them may have like 12 months leases on specific rates that they need to do these things, but they won't report those going forward. So should I be checking footnotes?
No, because it's a rolling one-year lease. The effect of capitalizing and treating it as debt.
So don't try to. Perfect.
You can draw that I can use the bathroom and Batya.
Hi, how are you?
Hi. So
Yeah.
what should I meet you somewhere else? These people got down there.
Yeah, I was going to go up very quickly, but
Okay, so I can meet you in your office.
yeah, I'll be there in about 5.
Yeah, I have a question about the quiz, but
Yeah.
is it better to come to your office or can I ask you? Question 2.
Yeah.
Everything the same way as the answer model. The only thing I maybe did is rounded this to 3, it was 2.99.
Okay, so you should.
Yeah.
Just email me.
Yeah, I will do that. And about this one, I was wondering, so this formula I got from your slides.
And it should work if you were consistent.
Yeah, so where did I go wrong? I'm not far off, because your answer was 2,000.
If it had been higher than it's a 1 plus C, I'm just surprised. You know what problem you have when you took out the 1 plus C right? You back at a higher cost of equity. You know what? I'll give you the 1.5. I think that is just because you used the 1 plus C and it's at the lower cost of equity. Now I have the higher cost of equity, then I just have a 9%, you're not having 9%.
Yeah.
That's having a bigger effect on the equity.
All right. So then
It's
that's that. Okay.
Quick question, when we submit our final project,
Yeah.
do you want to see all of the Excels for each individual company or just that sort of summary? Just the summary?
The more creatively you can summarize your valuation, the better, right? So if you figure out some way of presenting it, not in a table as much as, something that conveys.
I have a question for you.
Yeah.
My girlfriend's father is Pakistani, Muslim, and
Okay.
in finance.
Okay.
And he does not like me, but he loves you.
Why doesn't he like you?
Because I'm not Muslim or Pakistani.
Okay, that can be a factor.
But it's something we're working on, and his name is Zia.
CIA.
ZIA. And I'm wondering if you can mention something about humans having an intrinsic value from the God valuation as part of my peace offering.
Okay.
I wanted to say still.
No.
She was just saying that they talked.
Yeah. Are you both before or after or what?
Yeah, sure.
Yes. I'm done. There we go. Done. Today is June 31st.
Don't say anything.
My preferred date is June 24th. Does that still work with my team?
Well, no, he is.
Oh, he's your boss.
Thank you so much.
You're welcome. Good luck to you.
Thank you.